Hey, what is going on, guys? It's your boy Freddy. Welcome back to the channel. Many of you have probably noticed your portfolios dipping over the last few weeks as the broader market has completely erased the gains that it's seen so far in 2021. And you might be a bit worried about the current state of the market as we inch closer and closer to a correction, which is when the market dips 10% from its all-time highs. For those of you who are long-term investors, you already know that all of this panic and uncertainty simply mean that stocks are on sale and it's time to buy your high conviction companies that you believe will continue to grow once the dust settles. Every time there's a drop in the market, I like to look at previous periods when there was panic and see how quickly the market was able to recover. If you guys remember, just recently the S&P dropped around 8% in October during the US election, and people thought it was the end and we were heading for another major crash. However, the market quickly recovered, and when you look at that drop compared to a 10-year chart, it's hardly even noticeable. So if you are a long-term investor with more than 10 years before you begin to draw down from your account, this should help to assure you that this is all a part of the process and you shouldn't worry too much as long as you have strong fundamental companies within your portfolio. On average, you can expect a 5% drop around 3 times per year and a 10% drop on average once a year. So for someone who's going to be in this market for many years to come, I see these dips as buying opportunities. And today I want to go over 3 stocks that I'm going to be looking to buy during these times. My rationale for these choices is that they're companies that I believe in wholeheartedly that they will continue to grow, and I don't have to worry about their future, and instead I can buy them on a consistent basis and enjoy the rewards in the years to come. Coming in at number 1 is QQC, which is an ETF that tracks the Nasdaq top 100 companies. I'm a big fan and believer in tech companies, and I think that they will continue to see the crazy growth that they have over the last 10 years for many more years to come. Companies like Apple, Microsoft, Amazon, and Tesla are amazing innovators, and I see no reason why these companies wouldn't continue to grow for the foreseeable future. These companies rely on their innovation and bleeding edge technology to stay at the top of their game, so it makes sense why they have seen the growth that they have. With Apple starting to branch out their revenue streams with a potential push to EV, to Amazon continuing to grow their giant empire, I'm extremely confident in these companies and what the future holds for them. QQC specifically focuses on giving exposure to companies that are at the forefront for disruptive industries like augmented reality, cloud computing, big data, streaming, EV, and much, much more. Although an S&P ETF will have some of these types of companies in their holdings, a Nasdaq ETF focuses more solely on these industries, which means that you will see a higher percentage of the overall ETF valued into each individual company, which is what I prefer as I will be invested for the long term. It's really important to note that because these companies are growth-oriented companies, they are subject to more volatility. For example, looking at the current dip, we can see that the S&P is down around 2%, while the Nasdaq is down almost 10%. There are certainly other factors behind these differences, but as a general rule, you will see larger drops with the Nasdaq. In my opinion, this recent pullback for the Nasdaq was well overdue. With all of the money that has been flowing into the market since the illness began, the Nasdaq has been absolutely inflated. And looking at the chart, you can see that had you bought at the market bottom, which happened less than a year ago, you would have been up almost 100%, which is absolutely crazy. So this dip, in my opinion, is completely healthy as you don't want the market to grow too quickly, which can lead to bubbles like we saw in 2000, and pullbacks like this one can really help to ease that pain. Next up is Algonquin Power and Utilities, which I believe is both a growth and a dividend play. I have talked about this company in more detail in my top 3 Canadian dividend stocks to buy video linked in the description, but to give you a quick overview, this company is a utility company here in Canada that invests in hydroelectric, wind, and solar power facility and utility businesses. I am really bullish on this industry as a whole, and with the very high projections for growth within the industry, this recent dip is looking like an extremely attractive opportunity to increase my position in the stock. Just before this market dip, I did start to slowly add a position to my WealthSimple dividend portfolio, but with how much this stock is discounted, I am going to be looking to add more heavily to this stock than I was initially planning on. Initially, I was only going to be purchasing a few shares every month to slowly build up my position, but with how much upside I now see with the company as the market continues to dip, I am going to be taking advantage of the opportunity and dollar cost averaging more heavily. Full earnings for 2020 also recently came out for AQN, and I'm really liking the growth that the company has seen. Revenue is up 3% for the year and 12% in the last quarter. Net earnings are up 12% and dividends per share are up 10%. This growth is absolutely phenomenal given everything that transpired during the year, and it shows the potential this company has to scale and become even more profitable in the future. These earnings, along with the recent statement from the CEO, have really cemented my strong opinions I have for this company. He said, "We are pleased to report solid fourth quarter and full 2020 results, which despite the year's challenges due to the COVID-19 pandemic, reflect year-over-year growth in all of our key financial metrics and several exciting new growth initiatives." He then goes on to say, "We remain confident that our robust $9.4 billion capital expenditure plan from 2021 through 2025 will continue to drive further growth in earnings and cash flows. I'm extremely excited and optimistic about this capital expenditure plan. I believe that it can really help the company to grow and increase its market share over competitors like Brookfield and Hydro One. But with the growth that I do see for the industry as a whole, you honestly can't go wrong with buying into any of its competitors. I have been looking for an ETF that focuses solely on renewable energies here in Canada, but I haven't been able to find one. So if you guys do know of an ETF that does focus on this, let me know in the comments down below. The final company that I want to go over is Alibaba, ticker symbol BABA. This company has been beaten down heavily since October of last year due to an antitrust investigation against the company, and this recent market dip has further dropped the stock price. Basically, Alibaba was accused of not letting its vendors list their products through other retailers, and also Chinese regulators blocked Ant Group, which is a fintech company which Alibaba owns a 33% share in, from going public, as it did not meet certain listing conditions and certain disclosure requirements. This investigation, in my opinion, was just a flex on Alibaba by the Chinese government to try to make them realize how much control that they do have over the company. But I don't think that this is a major issue for long-term investors, and we should instead focus on what has transpired since that situation. Alibaba recently won a bid to actually help the government with its online payment processing systems through cloud-based solutions. Basically, what this means is that Alibaba will help the government by being a key technical service provider for the cloud platform, which will perform all third-party payment transactions that take place. Chinese online payments are currently booming and have seen rapid growth over the last few years, and this could become an extremely important revenue stream for Alibaba for the years to come. This contract to me shows that the relationship between Alibaba and the government is actually really strong, and that the public opinion is far too negative. If the government really was trying to break up Alibaba's monopoly, they would have blocked their attempt to try to win this contract. The company has seen over 29% annualized growth over the last 5 years and sales growth of 27% during the same period. Also, their cloud business has seen a 60% year-on-year increase and should further grow with the addition of the transaction platform. This new contract, along with the already amazing growth of the company, make me believe that this stock is undervalued, and this is also reflected by the PE ratio. Amazon, which is Alibaba's most related competitor, has a PE ratio of 71, which I think further shows the potential that Alibaba truly has. Well, those are the 3 stocks that I'm looking to buy during this market dip. Let me know in the comments down below what you guys are buying. Also, remember to hit that like button, as it really does help the channel to grow, and consider subscribing for more investing videos like this. I also have a WealthSimple referral link in the description that gives you $10 when you deposit and trade with 100 or more, which is an instant 10% return on your money. I'll catch you guys in the next one.